Hey everyone, and welcome back to the channel. Today, we're cutting through the jargon to break down two titans of the telecommunications world, Comcast and Charter Communications. If you've ever watched TV, surfed the web, or visited a theme park, you've probably interacted with one of these companies. We're going to compare their strategies, finances, and what it all means for you, whether you're a customer or an investor. Let's dive in. Visual aid, split screen with Comcast logo on left, Charter logo on right. On-screen text, Comcast versus Charter, who's winning? First up, let's talk about their core businesses. Imagine two companies that started off selling cable TV, but then took totally different paths. Comcast, the media and connectivity powerhouse. Comcast decided to go big and broad. They vertically integrated, which means they own everything from the internet pipes that bring content to your home, like Xfinity Broadband, to the content itself, through NBC Universal, think movies, TV shows, and even Peacock streaming. They even own massive theme parks. Visual aid, animation of Comcast logo. Text, Comcast, Xfinity, NBC Universal, Peacock, Universal Parks. They recently made a huge move to sharpen their focus. On January 2, 2026, Comcast spun off most of its traditional cable TV networks and digital media assets into a brand new, independent company called Versant Media Group. Visual aid, animated graphic. Comcast logo splits into two, one larger, Comcast, and one smaller, Versant Media Group. On-screen text, Comcast, shedding legacy TV, focusing on growth. Why did they do this? To let go of those older channels that are losing subscribers to cord cutting, like CNBC, USA Network, Fandango, and focus on the high-growth, high-profit areas, residential broadband, wireless services, their business solutions, NBC Universal Studios, Peacock, and global theme parks. These now make up about 60% of Comcast's revenue. Charter Communications. The pure-play connectivity provider Charter, on the other hand, went a different route. Under their Spectrum brand, they're focused almost entirely on being a pure-play connectivity provider. Think high-speed internet, mobile services, and value-priced video packages. They don't own big movie studios, streaming platforms, or theme parks. Their game plan is all about expanding their network, getting more customers, and keeping them happy by bundling services. Visual aid, animation of Charter logo. Text, Charter, Spectrum Internet, mobile, video bundles. Money talk, revenue and profit. Looking at the last 5 years, these different strategies have led to different financial results. Visual aid, simple line graph showing Comcast revenue slowly rising, Charter revenue flatlining / slightly declining. On-screen text, revenue trends 2021 to 2026. Comcast has seen pretty stable revenue growth, thanks to a mix of things like post-pandemic recovery for their theme parks and media, even with some ups and downs. Their net income, the profit they actually keep, has been a bit like a roller coaster, swinging wildly due to things like big asset sales or write-offs. For example, a huge profit jump in 2025 came from selling their remaining Hulu stake to Disney. Charter's revenue has largely stagnated. They're facing pressure from people dropping traditional TV and home phone services, and even their advertising sales have taken a hit. Their net income has been pretty flat, showing the operational challenges they face. How they share the wealth. Dividends versus buybacks. This is where their strategies really diverge for investors. Visual aid, scale balancing, dividends, on one side, Comcast, and share buybacks, on the other, Charter. On-screen text, Comcast, income stock, versus Charter, growth by buybacks. Comcast is what we call an income-oriented stock. They've consistently paid and increased their dividends for 19 straight years. This makes them attractive to investors looking for steady income. In 2025 alone, they returned over $11 billion to shareholders through dividends and share buybacks. Charter, however, pays no dividend. Instead, they use their extra cash for aggressive, debt-financed share buybacks. This means they buy back their own stock from the market, which reduces the number of shares outstanding and can make each remaining share more valuable. While this can boost earnings per share during good times, it also means they operate with a lot of debt, making them more sensitive to interest rate changes. Who owns the market? In the U.S. high-speed internet market, Comcast and Charter are like two big elephants in the room, each holding about 25% of the market share. Visual aid. U.S. map highlighting areas served by Comcast and Charter. On-screen text. Broadband duopoly. 25% market share each. But both are facing tough competition from 5G fixed wireless access, FWA, providers, think T-Mobile and Verizon Home Internet, and new fiber optic companies. To fight back, both are bundling discounted mobile services with home broadband, which helps them keep customers. Visual aid. Icons for 5G FWA and fiber optic internet. Text. New challengers, 5G FWA and fiber. Comcast also has a big international presence through its Sky subsidiary in Europe, which gives them a leg up on geographic diversification that Charter doesn't have. Comcast's unique assets. Content and theme parks. Comcast's ownership of NBC Universal is a huge differentiator. Visual aid. Icons for Peacock, Universal Studios, Universal Parks. Text. Comcast, media and experiential entertainment. Peacock, their streaming service, hit 46 million paid subscribers in early 2026, growing significantly. With exclusive sports rights like the Super Bowl and Olympics, it's becoming a major player and is expected to become profitable soon. And then, there are the Universal theme parks. Comcast is giving Disney a run for its money. With the opening of Universal Epic Universe in Orlando in 2025, their theme park revenues surged. They're even investing over $8 billion to build their first European resort in the UK. Visual aid. Photo of Universal Epic Universe. Text. Universal Epic Universe, a major growth engine. Profitability and debt. A clear contrast. Let's look at their financial health. Visual aid. Infographic comparing gross profit margin, operating profit margin, net profit margin, and debt-to-equity ratio for both companies. Comcast has a much higher gross profit margin, 71.74% versus Charter's 56.53%, because of its high-margin entertainment properties and content. However, its operating margin is lower because of all the money they spend on content creation, talent, and theme park investments. But here's the kicker. Comcast has a relatively low debt-to-equity ratio, around 96 to 107%, which means they don't have huge interest payments eating into their profits. Charter boasts a superior operating profit margin, 23.57%, because it avoids those expensive media and theme park development costs. But its net profit margin is much lower, 9.1%, because of the massive interest payments on its $83.89 billion debt load. Charter's debt-to-equity ratio is an astounding 613.9%. This makes them extremely sensitive to changes in interest rates. What does the future hold? Both companies face opportunities and risks. Visual aid, split screen, growth drivers, icons for mobile bundles, DOCSIS 4.0, Peacock, Universal Parks, versus systemic risks, icons for FWA/fiber competition, rising content costs, interest rates. Growth drivers. 1. Bundling, keeping customers by combining internet, mobile, and maybe even TV. 2. Network upgrades. Rolling out faster internet with DOCSIS 4.0 technology to compete with fiber without having to rip up and replace everything. 3. Comcast specific. Peacock becoming profitable and the global expansion of their theme parks. Systemic risks. 1. Broadband losses. The biggest threat is losing internet subscribers to 5G FWA and fiber companies. 2. High spending. Both are in capital-intensive cycles, with Charter building out its network and Comcast funding theme parks and expensive sports rights, like the new NBA deal for Peacock. 3. Interest rate sensitivity. This is huge for Charter, given its massive debt. If rates stay high, their borrowing costs will skyrocket, eating into profits. Recent updates. Q1 2026 and beyond. Comcast's Q1 2026 saw revenue up, thanks to the Super Bowl and Winter Olympics broadcast on NBC Universal, and Peacock's revenue surging. However, net income fell due to those high sports programming costs. On the bright side, their broadband customer losses narrowed, showing some stabilization. Charter's Q1 2026 was tougher, with both revenue and net income falling. Their broadband subscriber losses actually widened, highlighting intense competition. And don't forget Comcast's Universal UK Resort, a multi-billion-dollar commitment backed by the UK government to build their first European theme park, creating a massive new growth engine. Visual aid. Photo of UK flag with Universal logo. Text. Universal UK Resort. A major European expansion. Investment takeaways. Who's for you? So which companies should you consider? They're built for different types of investors. Visual aid. 2 distinct investor personas. 1. Conservative, with a piggy bank. 1. Aggressive, with a bull market icon. Text. Comcast. Defensive value and income. Versus Charter. High beta. Leveraged growth. Comcast, CNC say, this is for the conservative, income-focused investor. Pros. Diversified business, reliable and growing dividend, currently around 5.5%, strong balance sheet with low debt, and a relatively low stock valuation. Cons. Moderate overall growth, high capital commitments for parks and content. Charter, CHTR. This is for the aggressive, high-risk, high-reward investor looking for capital appreciation. Pros. Superior operating margins, very aggressive share buybacks, which can really boost share price if things go well, and a deep valuation discount. Cons. Extremely high debt, no dividend, and a less diversified business model making it vulnerable to broadband losses. Ultimately, both companies are navigating a rapidly changing industry. Your choice depends on your investment goals and risk tolerance. What do you think of Comcast and Charter's strategies? Let us know in the comments below. And don't forget to like this video and subscribe for more insights. See you next time.